You miss one payment, just one. Maybe you forgot. Maybe something unexpected happened. Maybe you were a few days late and thought it wouldn't matter. It doesn't feel like a big deal. But months later, even years later, that one late payment is still there, still affecting your credit, still shaping how lenders see you. So the real question is simple. Why does one small mistake follow you for so long? Part of the frustration comes from how human the mistake feels and how inhuman the response seems. You know what happened. You remember the context. The system does not. And that gap is where most of the confusion lives. When you make a payment on time, it gets recorded. When you miss a payment, that also gets recorded. But those two records are not treated the same. Good behavior builds quietly, over time. Missed payments stand out immediately. Because the financial system isn't built to remember intentions or effort, it's built to remember risk. Every time you borrow money, you're being evaluated on one question. How likely are you to pay it back? That evaluation doesn't come from a person sitting across a desk. It comes from systems, algorithms, data models. These systems don't think the way humans think. They don't hear explanations. They don't weigh excuses. They don't care if the delay was reasonable. They look for patterns, and a late payment breaks a pattern. Think of your credit history like a long timeline. Every month adds a data point. On time, on time, on time, on time. Then suddenly, late. That single late mark becomes a signal, not just of what happened once, but of what might happen again. From the system's point of view, the past is only useful because it helps predict the future. This is what makes credit a kind of risk memory system. It doesn't just store events, it remembers behavior. From a lender's perspective, a late payment introduces uncertainty, and uncertainty is expensive. If a borrower stops paying, the lender loses money, so the entire structure is designed to reduce surprises. That's why even one disruption can raise your perceived risk level. And once that risk level changes, it doesn't snap back immediately. The system wants evidence before it relaxes again. That evidence is consistency. Here's something most people don't realize. The system doesn't actually reward perfection. It rewards consistency over time. If you make one late payment and then follow it with years of on-time payments, the damage does fade, slowly, but it fades. What it doesn't do is cancel out instantly. From a data perspective, one good action doesn't erase one bad action. Instead, your behavior gets averaged across time. Patterns take time to form and they take time to change. Trust in this system has inertia. That's why lenders prefer borrowers with long histories of steady payments, not because they believe those people never make mistakes, but because their behavior is predictable. And in finance, predictability equals safety. This is also why the emotional reaction often feels mismatched. You fix the problem right away, but the system keeps watching. From its point of view, the question isn't whether you corrected the mistake, the question is whether the mistake was a one-off or the first sign of something bigger. And the only way to answer that is with time. Now, this is where the story shifts, because the system isn't just about punishment, it's also about profit. When your risk goes up, lenders don't always say no. Often they say yes, but on different terms. Higher interest rates, lower credit limits, stricter conditions. To the system, risk isn't just something to avoid, it's something that can be priced. If you're seen as slightly riskier, you might still get approved, but at a higher cost. That higher cost compensates the lender for taking on more uncertainty. So that one late payment doesn't just follow you, it can make borrowing more expensive. The system isn't only remembering your mistake, it's monetizing it. This is why people sometimes feel like they're being charged for the past. In a very real sense, they are. Not because the system is moral or vindictive, but because it's transactional. Risk has a price. So why does it take years to recover? Not because the system wants to punish you forever, but because it wants to observe you long enough to trust you again. Over time, new data starts to outweigh old signals. More on-time payments, more stability, more proof that the late payment wasn't the beginning of a pattern.
Gradually, that late mark matters less. Its influence shrinks, but until enough new behavior accumulates, it stays part of your financial story. This is why people often hear that a late payment can follow you for years. It's not just a rule, it's how the system measures confidence. And once you see that, something else becomes clear. If the cost of borrowing is determined by risk, why do people who already have money so often get the lowest rates? Why is borrowing actually cheaper for them? Because money itself reduces risk. Higher incomes absorb shocks more easily, savings create buffers, assets act as collateral, long histories signal stability. Even timing matters. People with resources can wait, shop around, and avoid borrowing under pressure. Lower risk leads to lower rates. Lower rates make it easier to build wealth, and that feedback loop keeps reinforcing itself. So when you miss one payment, the system isn't judging your character. It's updating a probability, it's adjusting a forecast, and it's charging accordingly. Understanding that doesn't make the experience less frustrating, but it does make it less mysterious. Because what follows you isn't the mistake itself, it's the question the system keeps asking afterward. Can it trust the pattern again? And that question in this system can only be answered slowly. After all, we're just asking, aren't we?